VCs are a favorite punching bag for social media hate, and sometimes deservedly so. They have a reputation of being bloviated, entitled capitalists who have no idea how to run a business. I've been a venture capitalist for a decade, and in this video, I'm going to share the 5 most common reasons I see how VCs behave badly and why. The first reason VCs behave poorly is just the complete opacity in the industry. This is a world where, unfortunately, a lot of bad behavior never makes it to the surface. Especially in Silicon Valley, there is more of a pay it forward ethos as opposed to tear others down. And while I think that's a beautiful thing, it means that most of the time, people aren't shaming other people for behavior publicly. I think whenever you have a fundamental lack of opacity, you're going to have some bad behavior lurking in the shadows. Compared to public markets investing, where investor behavior may be more open to scrutiny, private markets investors fundamentally just don't have that level. I would actually say private equity investors behave on average in a much less founder-friendly way than VCs. But for whatever reason, I think VCs oftentimes have a more public persona. And this is the second reason, I think, why a lot of people bash on VCs, which is it tends to draw a lot of folks who are motivated by the fame and infamy of being a venture capitalist. It's one of these classic jobs that you see sort of swashbuckling dudes in Hollywood movies take as their profession. And I think it sometimes gets this reputation of being an incredibly glorious kind of sit back type of job. But I think the reality is venture capital as an industry is just so brutally competitive. There's no way you can actually do that and have a career. By the way, you can check out this video on my channel for the 5 biggest surprises for why VC is such a difficult industry to succeed in. But this industry is one that attracts a lot of big personalities, many of whom do want to be publicly visible. And I think naturally there's just a lot of people who don't like that kind of persona. This is most a problem because venture capital is a world where there's actually not a lot of real differentiation in the products that they're selling. At the end of the day, all money is green, and most VCs, in my opinion, don't have a real differentiated value proposition. This is part of the reason I joined Signalfire, which has a really unique model as a tech company, building products and services for our portfolio founders. I would argue the core competency of most VCs is marketing, and specifically influencer marketing, building up of your personal brand. In fact, at funds like Andreessen, there are specific quotas for how many tweets and posts that you should be authoring in a given period of time. That results, I think, in tons of VC marketing out there where maybe there's not a lot of differentiated substance behind it. But I think the real biggest driver of poor VC behavior behind the scenes is actually incentive misalignment. There's 2 forms of this. The first is career misalignment. You have to remember venture capital is this crazy industry where oftentimes early stage investors will make an investment and it's going to be 10 to 15 years before those companies actually return anything to the funds. As a result, the feedback loop is just so intensely long. We can't all sit around and wait 10 to 15 years before, anybody gets a promotion. What happens in those sorts of vacuums is they get filled by politics. This isn't just true of VCs, it's true of any industry, but I think it's most acute with venture capitalists because I'm not aware of an industry where you have such a long feedback loop in how somebody in the job is actually performing. What that means is there's a lot of politicking and self-bravado on how great the companies that a VC is investing in is actually doing. And as I mentioned, this is a very opaque industry, so there's very few people who actually know how the company is doing. And as a result, there is a lot of incentive for VCs to be full of BS and chest pound. The other big alignment is economic. The venture capital industry has become so large where you have such large pool of capitals like sovereigns internationally deploying money into venture capital as an asset class that these funds have also bloated up in size where you can actually become generational wealthy just from the fees, regardless of whether or not you succeed as a venture capitalist. The ideal scenario is you have economic alignment where you only make money if you actually make good investments and you return money to your investors. Typically, this is done through a profit-sharing mechanism called carry. And historically, fund sizes really weren't large enough to get rich off of the fees. Think of a $50 million fund where the fees might be $1 million a year. But by the way, you have to pay a staff, back office costs, etc. At the end of the day, you may not actually be taking home a lot if you're the VC running that fund. But now with fund sizes that are 10, 100 times bigger, there are partners at these funds that could potentially be earning $3, $4, $5 million per year. And many of these folks haven't actually returned capital. And many of these younger folks who've been promoted into senior roles haven't actually returned money yet. That can create all sorts of misalignment of interests, both at the firm level, in which maybe you are incentivized to deploy more capital than companies should be taking in, and at the individual level. For example, a fund may be at a certain part of their lifestyle where they would only make significant economics if a company were to be a massive home run. And as a result, let's say selling the company for 100 or even a few hundred million, where the founders own most of that. A VC may have invested at a $500 million valuation, so they'd only be getting their money back. And they may be pushing the company to take extraordinary risk to see if they can become a generational company, even if it's only a 1 or 2% shot that happens. On the other end of the spectrum, you may see VCs who need to show some sort of return to be able to raise their next massive fund and continue collecting those fees. And as a result, they may be artificially pushing many of their companies to sell in advance of their true potential. Here's a vivid example. Let's say a VC invested $50 million into a company at a $500 million valuation. The company's chugging along, but not performing amazingly well. As a result, the company could probably only sell for maybe 200 or 300 million. If the company has only raised 50 million, VCs are first in the preference stack, meaning they're the first ones to get their money back. For the sake of simplicity, let's say the company has only raised 50 million. That means the VC would get the same amount of money whether the company sold for 50 million or 500 million. It may be many years before the company could make enough progress to get above a $500 million valuation. So the VC would rather the company just sell now for 50 million, and they would get all the money back with less effort. And in fact, a $50 million sale is much easier, faster, and simpler to do than a $500 million sale. This is just a taste of some of the incentives that drive misalignment between VCs, shareholders, and founders. The last thing I'll say is, as VC has institutionalized, you have a lot more bankers and consultants who don't have operating experience flooding into the industry. And I think it doesn't help when you have a lot of that persona who may not fundamentally have as much founder empathy as others. And I do think some of that contributes to a widening gulf between VCs and the operators who are running the businesses. All that said, this is part of the reason why I chose to work at Signifyer, which is we are economically aligned and spending most of our resources in data science, compute, engineering costs to build the products and services like our own recruiting infrastructure or go-to-market machinery that are helping founders scale in a differentiated way. If you're a founder, there's a saying that it's harder to get VCs off your cap table than it is to get divorced. And there's some definite truth to that. So hopefully this video might save you a lot of heartache. Thanks so much for watching. See you next time.